Hi, everybody. Welcome. Okay, we can get started. It's 2 minutes in. We have some folks trickling in. So first of all, thank you for joining. We wanted to set up some time and invite some of our partners over to this webinar to essentially have a conversation about, navigating cash management strategies in these times. We've seen over the last 2-3 weeks with the SVB crisis, a really massive influx of customers and partners across many different domains, law firms, accounting firms, investors, VCs, accelerators, coming to Brex to seek help for themselves and for their portfolio companies, and specifically as it relates to our business account product. And so we wanted to set up some time to answer some questions that some of our partners and customers had. And so I'm excited to chat through this. The structure that we're going to have today is essentially one where we're going to cover a set of slides probably in less than 5 minutes, and then essentially just go straight into Q&A. We have over 10 questions that folks submitted that we want to go deeper in and sort of have conversations with the audience. And so as you're listening to myself and Eric, who I'll introduce in a second, please ask questions here in the Q&A, and then we can ensure to tackle those after we've tackled the questions that folks submitted beforehand. But with that, let's get started. So quick introductions. I have been at Brex for 4.5 years, currently serving as the general manager of our startup business. Eric, I'll hand it over to you for a quick introduction.
Thanks, Lucas, and thanks everybody for attending today, our little webinar. My name's Eric. I'm the Chief Accounting Officer at Brex. I also started at Brex 4.5 years ago. I remember our first holiday party, Lucas, all that time ago. And I'm also the president of our broker dealer that runs the Brex business account. Thanks for attending today again.
Amazing. Cool. Okay, so essentially many of you and probably all of you know Brex at a glance. We serve 1 out of 4 startups in the US with our various different products. I like to, we're really loved by our customers, and we really do kind of operate and live by our customers as well. When we think through everything that Brex offers, it's an all-in-one finance, right? So we started with corporate cards. We evolved into business accounts. We have expense management software, financial planning software. So today, startups come to Brex essentially to have all of their finance in one place. With that, I want to jump straight into some of our learnings over the next 2 weeks and talk about cash management strategies. So with that, Eric, wanted to hand it off to you and ask this question. What have we learned over the last 2 weeks?
Sure. Great question. I think as a startup that's been dealing, like Brex itself as a startup that's been dealing with its own, struggles within economic uncertainty with our business and managing cash flows, et cetera. We've spent a lot of time over the last year thinking about like how we're going to manage our burn and things like that. And then one thing that popped up was, okay, on March 8th, we got the 8K, and we followed the news here on SVB, which was one of our banking partners at the time, that they sold $20 billion worth of securities, had about a $2 billion loss there. And we saw the markets tank right then and there. And I think at that time, we realized like, oh, okay, we have to figure out like what we're going to do to mitigate some of this liquidity risk that might be happening right now. And so what we did at Brex to prepare for all this, and I think this is one of the things that a lot of startups need to think about when they're managing their cash. What are the 2 highest objectives when you're managing your treasury or corporate funds, right? And if you go to the next slide, Lucas, those 2 things in my view are the preservation of capital and access to liquidity. When you think about the corporate funds that you've received from equity investors into your company, right? You're trying to get a return from your business operations from the use of those funds. The goal of those funds isn't necessarily to earn a great yield. You're not going to grow your company 10x or become a unicorn by investing in money market funds, treasuries, or any other corporate bonds, et cetera, right? You're trying to use that money to grow your business, putting it into your engineering team, putting it into your go-to-market motion, and building your business based on what the product that it is that you're selling to your customers. And so two things that I always try to optimize for our own treasury funds, and I also recommend this to our clients, considering the safety and soundness of where those funds sit, and then also optimizing for the ability to withdraw your funds or daily liquidity. You need to be able to make sure you feel good about safety and soundness, as well as the ability to use those funds when you need it to make payroll and other operational needs. And then after that, right, and Lucas, if you go to the next slide, after that, you can think about managing yield, right? It is a fact from a CFO's perspective or a chief accounting officer's perspective, right? You think about excess corporate funds that you have, you're not going to use them right away in the next month. There is value in figuring out how to extend your yield on that excess cash, which also extends your runway, right? But you also have to understand that higher risk also equals, like, you to get higher yield, you would need to take on some level of higher risk. And for some folks, right, it might not even be worth it. The extra 20 basis points, the extra 30 basis points that you might get from certain kinds of financial instruments, that's something that, yeah, you might get a few extra $1,000 or $10,000, et cetera, out of your cash. But that's not going to like help you grow your business that much. And so one option that we offer out of the Brex business account is, in our money market fund yield, we specifically selected a government money market fund, and it's a 2A7 fund. And what that means, it's regulatory speak for a fund that is required to invest at least 99.5% of its assets in straight cash or securities backed by the US government. And I'm trying to go through these slides quickly because I want to get right to the Q&A, because we did get a bunch of questions. Another thing that I want to note is that, right, when thinking about your cash management strategy, you've selected the places that you want to place your cash, right? Whether it's a bank, whether it's Brex business accounts, any number of places that you can store your deposits. I think it's really important to just follow up on the news on which institutions you've kept your cash in. And that came in handy for us, like, just to be honest, when the news hit, we were following it very closely. And what we decided that morning on the Thursday, March 9th, was let's pull out all the funds from all these banks that might be impacted by this potential large contagion in the banking system. So it's important to just, if you are in a seat where you're managing your corporate funds at the company, being aware of what's going on with these companies that you're placing your deposits with, understanding what risks they might be going through, and taking action accordingly and swiftly and decisively if the time comes. It's very rare, right? If you think about the last even 40 years, it doesn't happen very often, but in the times that it does, it's really important. And last but not least, I will just end off with just a small overview of what Brex Business Accounts is. This is a product that we run out of our broker-dealer, Brex Treasury. What we offer is an FDIC sweep as well as a high-yield money market fund sweep. Our FDIC sweep offers up to $6 million in FDIC coverage. And what we do is we take those funds, we spread it across 24 banks in $250,000 increments, and we get all the pass-through insurance that we can offer from those banks. And then for the money market fund, I believe the yield right now is about 4.3% or so. So it's pretty competitive out in the market, super secure underlying assets at the money market fund. And both of these options, right, we offer 100% liquidity at all times. And we don't invest those funds directly because we're not a bank, we're a broker dealer. And so there's safety and soundness there for our customers. The other thing that we do offer is out of those two suite products, we do offer payment services. And we provide wire, ACH, check services. We have dedicated 24-hour support. We also have a mobile app if you want to do your operating account activities that way. And that's kind of all I have to say about Brex business accounts. Maybe let's go straight to the Q&A.
Let's do it. Amazing. So we wanted to make sure that everybody had this context to just really jump into the Q&A. And so what I'm going to do is I'm going to read off some of the common questions that we got before this presentation. And please, if you have any questions, submit them as you're listening in the Q&A feature here in Zoom. So the first question, and this was a pretty common question, Eric, is what happens if Brex fails?
Great question. And a good one, because we have seen a few failures in the financial services industry the last few weeks. So in the unlikely event that Brex itself fails, or the broker dealer of Brex Treasury fails, we would also go into receivership at the broker dealer level. We are not regulated by the FDIC because we're not a bank. We are regulated by FINRA, and SIPC is our insurer for our business. And so what happens is when we go into receivership, the regulator would have access to all of our custodial records. And because we don't invest any of those funds ourselves for our own benefit, trying to make a yield, and we don't, we only invest in highly liquid securities, specifically this money market fund, or they're in the FDIC sweep, what I would expect is that after receivership, within 24 hours, all those assets could be liquidated and returned to customers pretty quickly. It's important for us, especially as the president of the broker dealer, I keep track of this all the time, but I make sure that we keep a strong set of books and records for our customers. So in case, again, very unlikely to happen, but if that misfortune were to occur, customers' funds would be returned pretty swiftly.
Cool. Helpful. And another common and related question that we got as well, Eric, was what happens if one of the underlying banks in our FDIC sweep fails?
Very interesting question. So we sweep the funds across a network of 24 banks to get to the $6 million of pass-through insurance. The way that works is we don't surpass the $250,000 mark for each of those banks. And so if one of those banks were to go into receivership, for all the customers that have dollars in there, it's all FDIC insured. And so if you look back on the events that happened subsequent to SVB's collapse, the first thing the FDIC posted was on that Monday after the weekend, right? They went to receivership on Friday. But on that Monday, the first dollars that would come out to customers was that $250,000 of insurance. And so, what happened with SVB was that the FDIC and Fed put in a backstop. But if that had not occurred and the originally planned events were to unfold, all that insured money would get withdrawn immediately. And that's what would be available to Brex. And so Brex would take those funds and then reallocate it to another bank in the network.
Cool. Very helpful. Another question that we got with some folks remembering the last financial crisis that we had was that in 2008, somebody asked, didn't a money market fund break the buck? And why is the Brex money market fund different? And so it might be worth you explaining, what break the buck means, and then kind of elaborating on what happened in 2008 and the difference that we have.
Sure. So typically when you invest in money market funds, one of the big objectives of the money managers within the fund is to keep the price per share at $1 per share, exactly $1, not $1.01, not 99 cents, but at $1. And there's different kinds of funds here. There's like institutional funds, I call them institutional funds that have exposure to corporate credit. And then you got government funds, which is what the Brex money market fund is. And that only has exposure to cash and government credit. 2008 was really interesting. That was an institutional fund. It was called the Reserve Primary Fund. And they had exposure to Lehman. They had, I forgot the dollar amount, but they had a significant exposure in short-term loans to Lehman Brothers. After Lehman Brothers collapsed, they had to take a big write-down on those loans. And it drove the price per share based on the valuation of the underlying assets down from $1 to about like 97 or 98 cents. So it, quote unquote, broke the buck, right? Because breaking the buck means it's not $1 anymore. A couple of things that I'll highlight on the difference between 2008 and now, as well as that fund and the government money market fund with Dreyfus that we offer today. The first thing is the Reserve Primary Fund had exposure to corporate credit, specifically Lehman Brothers, companies like Lehman Brothers, right? And as a result, it's a different credit profile than the government money market fund that we offer out of Brex business accounts. So you can see the risk difference there. Having exposure to a company like Lehman Brothers, where there was a run on that bank too, versus the exposure that we see in the government money market fund, that's only against cash and other securities that are backed by the US government. And so there's a lot more stability in the pricing of the instruments that are underlying our fund. The other thing to note is that in our government money market fund, the weighted average maturity is about 6 days. And so it's just a totally different risk profile, and there's much less risk in terms of breaking the buck for the government money market fund. The other thing to note is, like, you think about the history of money market funds prior to 08, it was almost like 40 years since the last time a money market fund broke the buck. And then since 08, there's been a lot of new regulations put in place for money market funds. So one of the things is they made a lot of amendments to Rule 2A7. And what that did was it did impact government money market funds. At that time, if you had a government money market fund, it was required to invest 80% of its assets in cash or securities backed by the US government. That was then updated to 99.5%. So subsequent to the Great Recession, right, they really looked at the structures of these funds and tried to reduce the risk there. And, you know, for government money market funds especially, it's nearly 100% invested in cash and government securities. The other thing they introduced was similar to Dodd-Frank for a lot of the larger banks. And you can talk about potentially like the deregulation of regional banks that occurred in the last few years as one of the things that may have impacted SVB. You know, they require also stress testing for these money market funds, right? To ensure that if there was a large liquidity event, that the fund assets will be able to handle it. And you're talking about a fund that has, you know, over $100 billion in assets. So it's quite important for that fund to be able to do that.
Very helpful. Another question that we got that I wanted to pose, Eric, is that when we look at preservation of cash, right? Today you can either deposit that fund in a bank account that is FDIC insured, or in a bank account that is not FDIC insured, as we saw with the SVB deposits, right? Something like over 90% of the deposits were uninsured deposits. And then the third option is you can invest it. And we've been talking about some of the safest kind of forms of investing that we see from our perspective. But how should you think about the trade-off between allocating funds into, you know, a bank account FDIC insured, and then specifically between a bank account not FDIC insured or investing in something like money market funds?
Yeah, so the way we've structured it is, I don't want to say a completely sliding scale, but there's a sliding scale here in terms of risk and yield. So for our FDIC sweep, right, we sweep it to a network of 24 banks. It's up to $250,000 at each bank, so it doesn't exceed the FDIC coverage cap. And what you get is pretty good safety and soundness, right? Like in our history as a nation, the FDIC has paid out up to the insurance cap the entire time the agency has been around. And so, you know, that's a strong history there. And what we're providing is a strong sense of preservation of capital with the FDIC sweep. On the other hand, you have your money market fund. The money market fund is also has a strong objective of preservation of capital because of the underlying assets that it invests in. But because it doesn't have that FDIC insurance, there is that extra yield that we're also able to provide and pass through. And so in terms of like how our customers think about it, like our product is self-directed. I don't necessarily think there's a wrong direction in either way in terms of like how you're managing your corporate funds. But maybe a good way to answer is that across our base, what we've seen is about 25% of the funds are allocated to FDIC and 75% are allocated to money market fund. And that way customers get a little bit of both safety and soundness, pure safety and soundness from the FDIC sweep, as well as some market competitive yield on the money market fund.
Cool. Very helpful, Eric. And one question that we also got was around what is the difference between the investment options between Brex and Mercury?
I have heard this question time and again. Mercury offers a different kind of product because they're backed by a DDA that's backed by Evolve Trust. Um, they also have an RIA that offers a sweep product into some investment instruments. So one of those instruments is a money market fund. And then the other instrument, I believe, is just a debt mutual fund that invests in ultra short-term fixed income instruments. So I think the big difference is that that mutual fund is not a money market fund, right? It invests in really short-term securities, but it's not governed by the 2a7 rules, and it's not required to hold its pricing at $1 per share. So there's no constant, we call it constant NAV. It's more of a floating price per share. And with that, you get a higher yield, right? So they invest in other kinds of securities beyond US government credit. It's a longer maturity or duration, and therefore it's a better yield for customers. For folks out there like managing their corporate funds, I think there's a choice that folks need to make. So from my perspective, I try to optimize for preservation of capital and liquidity first. Again, so a little bit more background on me. I joined Brex about 4 years ago. I was on the founding team that created the Brex business account. And when we thought about designing this product, I was thinking about how I would design it for myself, right? Because my other job is as the chief accounting officer of this company. And I worry about the financial operations and making sure we can pay our bills and make payroll and like all this other stuff, supporting the general business operations, which is where we want to make our return from the equity investments from our VC firms. And so that's kind of the main difference. I think there is a little bit more yield on the Mercury product. That's true, depending on the dollar volume that you can deposit there. But there's also a different level of risk with their money mutual fund choice. Excuse me. I think the other thing to note, and that's a difference between Brex and Mercury, is that we offer not only same-day liquidity from the sweep products, but we're also able to configured the product so that you can get the payments out same day as well. So it's kind of one smooth operation where you can do the withdrawal from the money market fund sweep and then also pay your vendor or make payroll, et cetera, in one fell swoop. Most sweep products in the banking industry, you request a withdrawal, the withdrawal ends up in your checking account, and then you have to make the payment to your final destination or recipient separately on the platform.
Very helpful. Okay, cool. We have about 5 minutes left, and we do have one question from the audience. And if anyone listening has any other questions, please feel free to submit and we'll tackle them. One question here: since Brex uses the cash balance of the corporate account to underwrite businesses, if we decide to move larger amounts of money from our account quickly across a number of different accounts, does Brex flag this? Or is there any impact on, for example, our credit score due to what may look like a reduction in the amount of cash? Great question. I'm happy to take this one briefly, but the short answer is we should be able to account for movement of cash in between your accounts. If that is within Brex business accounts, that is guaranteed. Like, we definitely can account for that. If those are bank accounts that you have connected to the Brex platform, so let's say a JP Morgan account that you're moving money onto another bank account, as long as we have visibility and those bank accounts are connected to the Brex dashboard, there shouldn't be any issue. However, just to make sure that you feel comfortable as you move funds, every Brex customer has a dedicated representative. And so when you log into your Brex dashboard, in the top right corner, there's a button that says support. If you click that, you'll see who your dedicated representative is. And that's your dedicated point of contact at Brex that you can text, call, email, whenever you want. And you can just let them know that you are about to make a transfer of funds, just to make sure that we account for that. And so we should already be doing that automatically. But if you want to be just really, really confident that you won't have any issues, you can just reach out to your dedicated representative.
Great.
Cool. Any other questions? I know a lot of you submitted questions beforehand, but if anyone has any other questions, we have about 2 minutes left. If not, we can wrap up. And if anyone has any other thoughts or questions that you want to ask one-on-one, feel free to, reply to the email that we sent with the invitation to this webinar. But thank you very much for attending, and we are here if anybody needs anything. We do have the preservation of capital and safety of your funds as a #1 priority. And so please reach out to us if we can help with anything. And Eric, thank you so much for the time. And everybody have a great rest of your Tuesday.
My pleasure. Thanks everybody for attending.
Bye, everybody.